So US inflation numbers came in better than expected. The headline number came in at 3% versus the expected of 3.1%, and the core number came in at 4.8% versus the expected of 5%, still high up there. But hey, look, the headline number is at 3%. Fantastic, right? And look at the equity markets. The equity markets are rallying up, going up in euphoria, saying, woohoo, we finally won. We finally won the inflation battle. Well, at least we're close to it, right? Because the inflation target for the US Fed is 2%. They gotta achieve 2%. And we're at 3%. And we've been coming down from the plus 9% level down to now 3%. So we must be doing something right. And hey, there's no recession too. The recession's over. We don't see anything bad happening in the economy. So all is well, right? Because if you look at NASDAQ's about 7% away from all-time highs. So there must be something there telling us that all is well. Or is it not? Well, I'm going to break down the CPI report, get into the inflation numbers, talk about whether I think this is set to do well or not, or whether, we might see a Goldilocks situation or not again. Again, these are just my opinions. This is not financial advice. I'm not a financial advisor. And of course, I can be wrong as well. Now, before I get into it, my name is Daniel. I run an organization called Infovest. Infovest is an organization that promotes financial literacy, teaches you about macroeconomics, ties it in with stocks, bonds, commodities, currencies, Forex, and crypto. And we try to teach you all that in a course. If you're interested in that, check out the website, www.infovesting.com. The link is in the description for you to read up on it and check it out if you like it. And if you just want to subscribe and learn about content and hear about macro news and finance and stocks and whatnot, then guess what? This is the channel for you. Hit the subscribe button and you will find out there's a lot of videos that I post here on the news, on macro and the markets. Now, let's get into it. Let's talk about CPI inflation. The numbers, like I said, the headline number, year over year number came in at 3%. Way better than expected. Now, another number that the markets look at and focus on, because the Fed is focusing on it, is called the super core number. What is the super core number? Now, there's a core number, right? Headline, core, then super core. So the headline number takes into consideration energy prices. And as you've seen, energy, crude oil has been dropping, and that's what's bringing the headline number down to the 3%, right? So, okay, that makes sense. Now, the core number takes the energy component out of it, right? Because energy can be quite volatile, as we've seen, crude oil jumping to 130, now around $70 to $80 a barrel, right? But when you take out the energy component of it, the number sits at 4.8%. So, okay, so inflation is coming down, but not so much, right? But the super core number, which the Fed introduced recently and said, hey, we're looking at the super core number. And what is this super core number? Well, the super core number basically takes the core number and takes out shelter. Just takes out shelter, and now you've got all these other components in it without shelter, and that number came in at minus 0.01%. Again, minus 0.01%. Just basically zero flat. And that basically tells you that, hey, the super core number is way lower than expected, did way better than expected, and that number has been dropping quite drastically because obviously you're taking the shelter component out of it. So if the Fed is looking at the super core number and saying that, oh, okay, if we're focused on that number and the number has been dropping and now it's flat, and if you really look at the number, it's kind of in the negative area. And as this trend continues, you can kind of predict that, hey, the super core number might get into more the negative area. Then, hey, that should mean that the Fed should stop hiking rates. That should mean that, hey, the Fed is winning on inflation, and maybe maybe they have managed to avoid the recession and you got this Goldilocks situation there. Now, I don't completely agree with that, but that's what you would infer and take when you look at the data. That, hey, look, the headline number is coming down, the core number is coming down, and the central bank who manages and decides what to do with interest rates is looking at the super core number, and that super core number is at zero, or even if, or you could say negative, right? So if that's the case, then all is well. Then yes, it makes sense. NASDAQ, which is only 7% away from all-time highs, and equities continue to rally and rally and rally, well then that means we've completely avoided a recession for now. Now, when you look at the inflation report, right? If you just Google US CPI inflation and you go to the BLS website, it tells you 70% of the increase in inflation that was seen comes from shelter. So the core component, which I told you was at 4.8%, right? This year over year number, better than expected, right? The expected number was 5%, but the number came at 4.8. Basically, a majority of that number, that increase, comes from 70% shelter. So we're talking about housing, we're talking about rent and whatnot. So that component is still high up there. And that's a problem, right? That's still a problem because, hey, you know, we're having a situation, we're having an issue where a lot of people are finding that living is very expensive. And not only living, food also rose in that month as well. Slightly, not so big, right? These numbers weren't so big, right? The month over month number core came in at 0.2%, expected was 0.3%, so not such a large increase. But there was an increase, but not so big. So shelter was 70% of it. Automobiles and yes, food also contributed to a higher number as well. And that's what's keeping the core component sticky. Now with this number at 830, also another number came out called the real earnings month over month number. The real earnings month over month number came in at 0.5% positive. The expected was negative 0.1%. So blockbuster beat there, right? So what is that telling you? That's telling you that, okay, yes, you know, energy prices have been dropping. Makes sense. That's where the headline number has been dropping, and that's why you see the headline number at 3%, yet the Fed needs to go to 2%. Now the Fed told us about the super core number. We'll hear what they have to say about that in the next FOMC meeting. I'm very curious from the Fed that, hey, now that you see the super core number, does that mean you're going to stop? Or does it mean that you're still going to assess certain situations? Because if you look at the shelter component, that's still sticky. Look at the job component, the labor market's still strong. Wages, real earnings, as I just mentioned, coming at 0.5% positive, is also showing you that, hey, labor is strong, wages are strong. So that means that inflation in certain sectors, certain areas are going to be sticky. And you don't want that, because inflation, even though it's coming down, it can definitely ramp back up again. And we've seen that in previous years, right? The last year and where inflation was coming down the summer, and then after the summer, it picked back up. You could see oil pick back up, energy pick back up, right? And with the continuation of strong labor market and strong wages, you can get people going back and spending all over again, and pushing up inflation, keeping it higher, and keeping it, most importantly, sticky, which the central banks would not want. So if this is a Goldilocks situation, or if, let's say, the situation of the recession is not coming this year, but maybe next year, or maybe later on, and we can still withstand with everything that's happening right now, the higher rates and so on, right? Then what does that mean to you or I, right? Or at least what does it mean to me when I listen to that? That tells me that the rates, even if they plan not to go up, they will stay there for some time and try to keep inflation, put a lid on inflation. And that some time could be until 2025. So you could see rates right now, right? Plus 5%, stay there, maybe even reach to 6%, stay there for some time until there is some sort of event. Because I really don't think that the central bank and the Fed is going to come out and start cutting rates all of a sudden. Why would you? The stock market's near 7% away from all-time highs, and the market's going up as the Fed continues to hike and continues to tighten. So why would you want to create crazy valuations? Like look at, for example, Nvidia bumping up higher, rallying higher, stock market's up, a lot of these tech stocks are up, and majority of the top tech companies out there are pushing the NASDAQ and the indices higher. Why would you want to blow that up even further? Because that's just going to make the situation of asset inflation worse off, right? So why don't you continue as a Fed member, right? If I was the Fed, why don't you continue to keep rates higher at elevated levels? Because the economy can handle it, right? And that brings me to my next argument, that if rates are higher for longer because the economy can handle it, when do they cut? Well, they probably will cut when the economy can't handle it, when people can't handle it anymore. Because right now, people, according to the data, can handle it. Now, you may not feel that, and I totally agree with you, right? The higher interest rates, the mortgage cost, the mortgage rates are higher, food is higher, groceries higher, so definitely people are feeling the pinch. But when you look at the data, although the data may be lagging, when you look at the data, yeah, it looks like the economy can handle it. The growth is still fine, which is why the Fed and the central banks may keep rates higher for longer. So forget about the idea of rate cuts. So today, it looks like a Goldilocks economy. Today, it looks like, we've got no recession, and that's fine. There could be many arguments of why that is, especially with the amount of money printing we did during COVID. Some arguments are saying that, hey, that still is having a lasting effect, right? I did a whole video on the Taylor Swift economy, right? People are going out. Taylor Swift is bringing billions of dollars to the economy because people are spending and booking hotels and so on. And the Fed loves it, right? Or maybe not love it exactly, but hey, that's what's keeping the economy upright and higher. So, and that's what's creating the money flow and people spending and keeping the prices high. So, but if that's the case, then why should the Fed cut? Because people can go and watch a Taylor Swift concert and spend money in hotels, even if the hotel prices and the ticket prices are much higher than what it was pre-COVID, right? So if that's the case, then great, keep rates higher for longer until maybe something breaks, right? Or maybe, again, the Goldilocks situation where maybe inflation comes down to the 2% or below, and then, hey, everything's fine, the economy's opening up more, blah, 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 trade war, whatever it is, tensions with China, tensions between Ukraine and Russia starts to solve, and there was no recession and everything's fine. There you go, the Goldilocks situation. Right? But I'm not calling it a Goldilocks situation. I don't agree with it, right? These are just my opinions. I'm not a financial advisor. Always consult with a financial advisor before making investing decisions. But I think that this is just a temporary blip up higher. We could make all-time highs. I wouldn't be surprised if we make all-time highs this year in the equity markets, if NASDAQ continues to rally higher and higher. But I would be very cautious about that move because, hey, if that's the case, that means everything's fine. If everything's fine, then why do cut rates? That means people can handle it. And until, something happens, some sort of event, then I see that where the rate cuts would come in. And even when rate cuts come in, that doesn't necessarily mean that the markets are going to bump up higher again. In fact, when you look at history, when the rate cuts come in the previous recessions, like 2008 and 2001 and so on, that's when you see the markets topple over. That's when you see real estate topple over, stocks topple over, and bonds just skyrocket. So those are just my opinions, just my thoughts. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.